there is a 40% exhaustion rate. That means that people are actually 40% of individuals who had been continuing claimants have now gone through the period at which they can collect unemployment benefits. That leaves them literally with nothing. So I think one of the greatest risks here is what we call the recognition of recession. Once there is a widespread acceptance that we are in recession, people tend to look at their portfolios differently. And I'm talking about everybody. Then I think that caused some disruption, certainly. Well, 2025 certainly was the year for gold. It is the ultimate hedge. If there's even a whiff of a financial crisis, gold has always been the safest of safe harbors.
As central banks worldwide accelerate gold accumulation in late 2025, with year-to-date net purchases reaching 634 tons despite record prices, a groundbreaking shift emerges. Russia becomes the first major nation to explicitly include silver in its strategic reserves, allocating $535 million for silver, platinum, and palladium acquisitions through 2027 as part of aggressive de-dollarization efforts. This move, combined with the Federal Reserve's pivot to end quantitative tightening and launch ample liquidity bond buying from December 1st, has propelled gold above $4,000 per ounce and silver past $51, creating fresh structural support for precious metals amid geopolitical tensions and monetary expansion. In this exclusive interview, renowned economist Danielle DiMartino Booth, CEO of QI Research and former Federal Reserve advisor, delivers a stark warning on the deepening U.S. labor market crisis. She highlights an alarming 40% unemployment benefits exhaustion rate, leaving millions with no income, near-cycle high continuing claims, hidden negative payroll revisions, and rising unemployment, now just 0.6% from triggering the Fed's recessionary Sahm Rule threshold. DiMartino Booth also cautions on the biggest market risk: widespread recognition of recession that could spark portfolio disruptions, forced liquidations, and renewed safe haven demand, even as passive investing flows and potential Fed political pressures complicate the outlook. Let's watch clips from Danielle DiMartino Booth's explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
Well, what the Fed has decided to do is to stop draining liquidity from the system. There will be some support at the margin for the Treasury market to the extent that mortgage rates continue to fall and refinancing continues to occur. Then you will see an increase in the mortgage prepayment rate, the rate at which people are paying their mortgage off earlier than what was expected. That will allow the Fed to get from its current about $20 billion a month run rate of mortgage-backed security roll-off up to that $35 billion a month ceiling. And as they continue rolling those mortgage-backed securities off, the Fed will replace them with treasuries. So in that sense, there will be, again, but just at the margin, some support for the Treasury markets. At some point, the Fed's going to be pressured to take interest rates down to the zero bound and restart quantitative easing. The problem is, I don't know anybody right now who the Senate would confirm who would simply do exactly what the administration wants them to do. Most of the main contenders right now to be the successor to Jay Powell, they don't buy into the philosophy that quantitative easing worked. I think we definitely trust more in the real-time continuing claims data because it does reflect something that is occurring in the month of November. And more importantly, there is a 40% exhaustion rate attached to that. An exhaustion rate means I have collected all of the claims as a continuing claimant that I'm allowed to do over whether it's 24 months for most states. I think it's 12 or 14 months in North Carolina, Tennessee, and Florida. But that means that people are actually 40% of individuals who had been continuing claimants have now gone through the period at which they can collect unemployment benefits. That leaves them literally with nothing in addition to this nearly 2 million cycle high that we're seeing in continuing claims. And if you want to go back to that 119,000 headline September payroll number, why don't we go back instead to June? Because that was originally reported as 160,000. And now we know that that was actually a negative print for that month. So I think what Fed policymakers are talking about more today than they were yesterday is the fact that the unemployment rate has risen. And that is what Chair Powell said that he would be focusing on going forward. And it is now 4.44%. So we're 0.6 of a percentage point away from the Fed's year-end 4.5% target as of September. Well, that is the job of the markets. It is to look ahead and anticipate what the value of any given firm is on any given day. I think Michael Burry has been as skeptical of the AI narrative, the AI bubble, because we've had a dramatic shift in the last 12 months away from we're going to be able to handle these trillions of dollars of investment to continue growing AI with cash flow and earnings to, we got to take debt out instead to finance the growth. And that has been the main shift over the last 12 months. And it is a lot of debt that these companies are taking on. It is the ultimate hedge when if there's even a whiff of a financial crisis. Gold has always been the safest of safe harbors. Unfortunately, there appear to still be some tourists who hold gold right now who won't necessarily have the stomach for potential volatility in the event that, like 2020, there is a margin call and people sell what they can liquidate the most easily at a profit.
Yeah, interesting. We got to go down that just a little bit here because for the audience, they kind of know what a margin call is. But if they're losing their house and they got to sell gold, are we close here? Are you looking at indications of this happening? We're seeing the sell-off right now in Bitcoin, I guess.
Well, Jeremy, we're too close to the end of the month for me to answer that question because the simple mechanistic, the way passive investing works is, oh boy, the stock market was down in November. In order to rebalance my target date 401k fund, if I'm 30 and I'm supposed to have 70% of my portfolio, therefore invested in the stock market, is to sell bonds and buy equities. And that's exactly what we saw, by the way, the day that the Fed came roaring to the market's rescue in March of 2020. It was the largest rebalancing day in the history of the market. So we don't know whether or not passive investing, because of its structure and because it buys prices agnostically, if we're going to have a huge rush of money into the market at the end of November or at the end of December when there's quarter end rebalancing. Well, 2025 certainly was the year for gold. But again, Jeremy, every single time passive has been tested, passive has won. So unless you're talking about people changing the allocations of their 401ks, which is not the easiest thing to do, or reducing their contributions to 401ks, or if you have enough people get fired who are contributing to their 401ks to start to turn that, in addition to retirees, right? 11,500 Americans retire every single day. They're no longer contributing to their 401ks. It takes a lot to tamper with the structure of the market that buys blindly. Dollar in simply buys the largest capitalization stock. It's why NVIDIA got to be a $5 trillion market cap stock, because you buy the biggest. And it's just a factor of the structure. So I think one of the greatest risks here is what we call the recognition of recession. And right now we've got 2/3 of Americans who, according to the University of Michigan, who foresee the unemployment rate continuing to rise. And that is a deeply recessionary print that we're talking about. But once there is a widespread acceptance that we are in recession, people tend to look at their portfolios differently. And I'm talking about everybody. Presumably the institutional investors already gotten out. But if there is a recognition of recession, especially with clear dissension inside the Fed, and the Fed making monetary policy for politics' sake instead of for the public good, then I think that caused some disruption, certainly.
The clock is ticking louder than ever, with continuing claims now pushing toward 2 million, the highest since the depths of 2021, and the unemployment rate frozen at a precarious 4.4%. Danielle DiMartino Booth's warnings are materializing in real time. The hidden labor fracture she spotlighted is no longer whispering, it's screaming through every weekly claims report, setting the stage for the explosive recognition of recession that could shatter complacency and ignite forced selling across risk assets. Yet in this gathering storm, gold remains the unbreakable anchor, still trading above $4,000 even on pullback days. Because when the Fed is finally cornered into zero rates and unlimited QE, the only winners will be those who listen to voices like DiMartino Booth and positioned in real money before the rush begins. The crisis isn't coming, it's already here. Get ready. If you found this breakdown helpful and want to stay ahead of these historic market moves, make sure to like, subscribe, and turn on notifications so you never miss an update. Your support helps the channel grow and keeps you informed when the markets shift next.